Very good morning, friends. So I hope you're all doing well. And as usual, your cumulative revision on consolidation is going on. So just to remind you, we were on the discussion of Ind AS 28, the last block in terms of Ind AS 28. I think we've come a long way in terms of consolidation standards. The journey started on Ind AS 103, and then we went to 110 and then 28. Now, let me, give you what is the focus for the day. So we're going to cover the block number 3 of Ind AS 28, which is talking of the other long-term interest in the associate. What is that other long-term interest? All that we'll see once we discuss that particular block. And then we're going to go to Ind AS 111, that is on joint arrangements. So focus mainly, of course, is going to be on 111, but of course, the third block, that is also important indeed. So I think let's begin our inputs in terms of the block number 3. I think I'm not making any mind map on the block number 2. I've, already done that in the previous session. So I'm going to directly start my inputs in terms of the block number 3. And that is given in the appendix to the standard. So when you look at Ind AS 28 in the appendix, they are talking about the other long-term interest in an associate. So I think let's first of all understand what exactly is the concept. And then there is a very wonderful illustration of the study material which elaborates the concept of those accounting for other long-term interest. So I think I'm just going to share some inputs from the study material. So this is long-term interest in associate or joint venture, and it says apart from. The word is apart from equity investments. I'll just crop this bit as well. Yes, let me zoom this. I think it should be visible enough. Let me know if this is clearly visible to you. Okay, so let me start the inputs and let's first read what is stated as far as the appendix is concerned. Now it says long-term interest. The word is long-term interest in associate or joint venture. It says apart from the equity investments. So one thing is very clear, that we are not looking at equity investments, we're looking at something other than equity investments. Now the question rises, what is something which is a long-term interest, but it's not an equity investment? Let's read further. It says an entity might hold financial instruments in associate or JV other than, it says investments accounted using the equity method. And these includes long-term interest that in substance, it says that in substance forms part of the entity net investment in the associate or a JV. Now, I think let me give you a little background. I don't know if you have done this or not. Ind AS 21, which is dealing with foreign exchange. Now, you will remember something if you have done Ind AS 21. Have you done Ind AS 21? I don't know, but I'm just going to give a reference to Ind AS 21. So any clue you've done Ind AS 21, right? Yes, great. Wonderful indeed. Now, if you look at Ind AS 21, there is a reference which is called NIFO. It's called net investment in a foreign operation. So if you remember, in terms of Ind AS 21, it talks of that, you have invested as a parent company, you've given them some kind of loans. Say, for example, for those loans, there is no period which is planned. So there is no repayment date. There is no fixed date of repayment, and it's neither planned nor it is going to happen in the future. So we say, those kind of loans are something which is in substance as good as an equity investment. Trust me, this is a similar kind of a concept. So as an investor, you put in some money into the associate company where it's neither planned nor there is any intentions. The word is planned and intentions. So we've not pre-decided any date, so it's neither planned nor we intend to you receive or pay that amount of money. And that could create something which is in substance as good as an equity investment. It gives you further examples. So for example, an item for which settlement is neither planned nor is likely to occur in the foreseeable future is in substance an extension of entity's investment in that associate or a JV. So the appendix to the standard says that as an investor, you have got other interest other than the equity investments, which is accounted under equity method. Now, what are those other long-term interests in substance? Those kind of, you can say investments where neither it is planned nor there is any intention to make payments in the foreseeable future. The key word is settlement is neither planned nor it is likely to occur in the foreseeable future. Now, what could be examples of these kind of transactions? It says such items may include preference shares and long-term receivables alone. The word is long-term receivables alone. Well, they will not include your common trade debtors, which are short-term in nature. So they will not include, it says, trade receivables or trade payable or any long-term receivables for which adequate collateral exists, such as a secured loan. So what is important is that there are going to be basically two kinds of security. One is, we said, could be a preference share. And the other one we said is a long-term receivable or a long-term loan. So typically two examples, one is a preference share and one is a long-term receivables alone. But the criteria is that the settlement is not planned, nor it is likely to happen in the foreseeable future. But if you're looking at normal trade receivables, you're looking at those long-term receivables, long-term loans, for where there is an adequate collateral, they are not a part of this net investment. Now it says, entity shall account for the long-term interest in accordance with 109. Now you would say, then why are we talking of this in terms of 28? If all these investments, whether they are preference shares, by such, I think it started on a very technical note today. It says it is noted that certain requirements of Ind AS 28 also apply to long-term interest, like allocating the share of loss of the associate or JV to such interest for testing the impairment and recording the investment, blah, blah, blah. Now, let me make one thing very clear. I believe the first thing we need to be clear upon is, when does this concept trigger? So I think let me just come back on the chain and give you something, first of all, to understand. If somebody were to tell me that divide Ind AS 28 in terms of accounting, what kind of permutations and combinations could arise? I'm being very clear on my words. If somebody tells me that, please divide the accounting of equity method in Ind AS 28, so I would say, okay, let's divide the accounting like this. The first case is that associate is a profitable company. So the first case is that the associate is a profitable company. That's one. The second case is that associate is a loss-making company. The associate is a loss-making company. So I would say there are two basic inputs which you need to apply in your mind. The first thought you need to understand is, ask yourself a very basic question. Is the associate a profitable entity or is it a loss-making company? Now, if you say it is a profitable company, in this particular case, this appendix which we are studying is not applicable. This appendix is not applicable. So that's one thing you need to keep very clear in the mind. So don't think of this appendix when it is a profitable company. Now, I'm putting this very clear. If it is a profitable company, so we are saying that this appendix is not applicable even if other long-term interest, even if other long-term interest is held. So even if other long-term interest is held, that does not make any difference to me. So even if the question gives me the data that, as an investor, you've got preference shares, you've got other long-term loans, which are supposed to be in substance equity investments, I am not concerned. The appendix is not applicable. Now, so I would say now there will be two cases in this particular case, two sub-cases in this case. Now, when you say that the associate is a loss-making company, I would say there can be two kinds of questions. One is that there is no other long-term interest. There is no other long-term interest in the associate company. Now, if you say that there is no other long-term interest in the associate company, then also the appendix is not applicable. Then also the appendix is not applicable. In this particular case, we have not seen any questions that if the associate is a loss-making company, how do you tackle that? So I think, let me say something at this stage, point blank. Just to give you an explanation on this case. Now, let's consider as an investor, your share in losses. Your share in losses is, let's say, 2 lakhs, and your investment in the balance sheet is standing at 1.8 lakhs. Now, I'm just considering this example. It's not a case of appendix, but you need to know the clarity. So let's say, for example, the investor's share in the post-acquisition losses of the associate is 2 lakh rupee. And the investment stands in the balance sheet at 1.8 lakhs. Now, what are you going to do in this particular case? In the balance sheet, the investment will appear at 0. Because you can reduce out of 1.8 lakhs a loss of 1.8, not more than that. So the investment in the balance sheet is going to appear at 0. And in the notes to accounts, you'll mention that there is a carry forward loss to the extent of 20,000, which is going to be adjusted in the future. I hope I stand very clear on my thoughts. So if the share of the investor in the post-acquisition losses is greater than the investment value, I'm looking at only this particular situation, where the share of the investor in the losses, the post-acquisition losses, exceeds the investment will be captured at a nil value. And any unabsorbed loss, mind the words, any unabsorbed loss is going to be written in the notes to accounts, which is going to be carried forward and adjusted against the future share in profits. I hope I make sense right. Now, coming back on the other picture. Now, once you've done this, here also, as I said, the appendix is not applicable, but I wanted to give you that insight. Now let's come to the fact that there is long-term interest. There is other long-term interest which is held in the associate company. So this is in the form of preference shares as well as in terms of long-term loans. Then I would say the appendix is applicable. Then I would say the appendix in this particular case is applicable. Wow. So, if technically somebody were to tell me that, okay, what are the various permutations, combinations, or the kind of questions you can get on Ind AS 28, I would say 4 questions. One is, I can say that the associate is a profitable company and there is no long-term interest. You've already done the accounting in the previous session. Second is, the associate is a profitable company and you've got other long-term interest. Appendix is not applicable. So the usual accounting which you've done. So the moment the associate is a profitable company, whether you've got other long-term interest or not, the appendix would not trigger. So in this case, the keyword is it is profitable. I don't care. As an investor, you've got other long-term interest or not applicable. Done. Second, the third case is when the associate is a loss-making company and as an investor, you've got no other long-term interest. The appendix does not apply, but we have not done this kind of question. That if the associate is a loss-making company, the typical case is when the share of the investor in the post-acquisition losses is greater compared to the investment value. You can show the investment at a zero value in the consolidated balance sheet, and the unabsorbed loss will be reflected in the notes to accounts as a carry forward. Next year, when you go to earn a share in the post-acquisition profits, you go to sell up this 20,000 loss against that movement. The fourth case is when the appendix would trigger. The associate is a loss-making company. As an investor, I've got other long-term interest in the associate, then the appendix is going to trigger. I guess, friends, I am crystal clear on my thoughts regarding the applicability of this particular appendix. Great, superb indeed. Okay, now with this particular inputs, we're going to go and see how the accounting of this is going to be done. So let me come back. So I am now going to do an illustration which is given in the study material. It's a wonderful illustration and people find this quite technical indeed, but I find it very interesting. So I am just going to first read the illustration. We're going to solve this in a very, very systematic manner. So let's, I think, first read this. This is illustration number 15 in the study material. Let's read. Though if you see, it says loss-making associate and long-term interest. You can see from the heading itself that there is a loss-making associate, condition 1, and you've got other long-term interest in the associate, condition 2. Therefore, the appendix would trigger. It says an entity has got 3 types of interest in an associate. Equity shares, 25% equity shares to which equity method of accounting is applied. Then it says preference shares which are non-cumulative and that forms part of the net investment in the associate. So he's already made it very clear that this is supposed to be other long-term interest, because it is considered as a net investment in the associate. Such preference shares are taken at a fair value as per Ind AS 109. Then there is a long-term loan. The loans has got an interest rate of 10% and the interest income is received at the end of each year. It is accounted as per the amortized cost as per 109, and this also forms part of the net investment in the associate. So the preference shares and the long-term loan, as per the instructions in the questions, are in substance as good as equity investments. So they're going to be treated as other long-term interest. Then he says at the start of year 1, the carrying value of the above interest is given. So at the beginning of the first year, this is the value of all these 3 investments. The following table summarizes the changes in the fair value of preference shares, and there is an impairment loss on the long-term loan, and there is entity share in the profit or loss of the associate. So 3 informations given. There is a fair value changes in terms of preference shares. There is an impairment loss on the long-term loan, and this is the share of the investor in the post-acquisition profit loss of the associate. Now let me also pinpoint. When you look at the preference shares, they are captured at FVTPL. As per the instructions, they're measured at a fair value. So any fair value changes are being taken in the profit and loss as per 109. So let me also tell you that in this particular case, the concept of impairment is not applicable. Because when you calculate, when you measure a particular investments at FPTPL, you've already seen in financial instruments, only the fair value changes are captured, no impairment is applicable. But in terms of long-term loan, it's taken at amortized cost. So in this particular case, the concept of impairment is absolutely applicable. And therefore, it is giving you the fair value changes and the impairment losses. Throughout year 1 to 5, there has been no objective evidence of impairment in the net investment of the associate. The entity does not have any legal or constructive obligation to share the losses beyond its interest in the associate. So the company will only bear losses to the extent of its investment. That's it, nothing beyond. Based on this, you're required to determine the closing balance of each of the above interest at the end of each of the year. So we are required to give now the value of these investments for the next 5 years. So at the end of each balance sheet date, he says what is the value. And this is what we're doing in consolidated financial statements, mind you. Okay, so now let's see how we are going to solve this particular question. Many people, get a little difficulty levels in this kind of a question. And I'm going to make your life simple. And I'm going to give you a 3-step model in terms of solving such a question, because that's going to make a life simple. So let's see how we are going to answer this particular question. So we're going to apply a simple 3-step model. And we're going to do all the 5 years in this case. We're going to take some time to solve this question, but understand the flow in which you need to proceed. So I'm going to first make a few columns. I'm going to make some few columns at this particular stage. So let's take the first column in terms of the investments. So we'll note down the investments which we have done. And let's note down the investments. So one is equity shares, preference shares, and long-term loans. So we've got equity shares. We've got preference shares, and we've got long-term loans. So these are the 3 investments which are done by the investor. Now, first of all, we'll note down what is the cost of these investments. This is at year 1 start. This is at the year 1 start. 10 lakh, 5 lakhs, and 3 lakhs. So we take this as 10 lakh. Then we take this as 5 lakhs, and this is at 3 lakh. Now, the step number 1 is you need to apply Ind AS 109 to these other long-term interest. I think let's make one thing very clear. So when it comes to the equity shares, you are going to apply Ind AS 28. And when it comes to the preference shares and long-term loans, you are required to apply Ind AS 109. So your step number one is to take care of the inputs as per 109. So what I'm going to do, I'm going to consider step number 1. So we're going to consider the step number 1, and in terms of the step number 1, we will apply Ind AS 109. We will apply the concept of Ind AS 109. So to the equity shares, Ind AS 109 is not applicable. So I'm putting a cross. Watch this very carefully. To the first one, that is equity shares, Ind AS 109 is not applicable. So keep it aside. Now let's come to the preference shares and the long-term loan. In terms of preference shares, there is a fair value decrease to the extent of 50,000. So I'm given that there is a fair value decrease and there is an impairment. So that is 50,000. So take care of the fair value change in terms of preference shares and take care of the impairment loss on the loan. So 109 is taken care. Once you apply the step number 1, you're going to get the revised value. You're going to get the revised values, which is post the step number 1. So this is also the values as per 109. So first, what you need to do, very carefully apply the concepts of Ind AS 109. any fair value changes, gain loss captured, and any impairment losses captured. Let's get the revised value. So this becomes 10 minus nothing. That remains 10. 5 minus this is 4,50,000. And 3 minus 50, that comes to 2,50,000. So this is the step number 1, getting the revised value as per 109, as simple and as straight. Then we go to the step number 2. Then I'm going to go to the step number 2. And in terms of the step number 2, we are now going to apply Ind AS 28. We're now going to apply the concept of Ind AS 28. So when you've done the step 1, 109, the second is to apply Ind AS 28. Now let's get back. You can see the share in the losses of the associate is to the extent of 16 lakhs. But the problem is the value of the investment in equity share is merely 10 lakhs. Now here is where the role of the appendix to the standard comes into play. What's this? Here is where the role of the appendix comes into play. Since this value is 10 lakh rupee, you cannot afford to reduce it more than 10 because of the max. The investment value could appear in the balance sheet as 0. It cannot appear at a negative figure of minus 6 lakh. So the standard says that you will give them a loss to the extent of the value of the investment. So 10 lakh losses given to the equity investment. Next. There is a 6 lakh of loss which is left over. Now the role of the appendix comes into play. The standard says that there is a loss of 6 lakhs and now this is to be borne by other long-term interest. But the question rises, in which order? In which order? We need to understand that when a company liquidates, what is the order in which the money is distributed? When the company will liquidate, the money will be given first of all to the lenders, the loan holders. Then the money is going to be given to the preference shares. And then the money is going to be given to the equity share. This is the order in which the money is paid. Now hear this carefully. The order in which the money is paid, you will first pay the money to the lenders, loan holders. Then you will pay the money to the preference shareholders. And then you will pay the money to the equity shareholder. So what does this mean? That the losses are borne by which people in which priority. If you say that I'm going to give the money to the loans and then to the preference and then to the equity, which means losses are borne by the equity first, then by the preference and then by the loan holders. So similarly, this loss of 6 lakh rupee. So we can say the remaining loss to the extent of 6 lakh rupees is borne by the same order. So first it's going to be borne by the preference shares and then it's going to be borne by the lenders, that is loan holder. Because when a company liquidates, you pay the money first to the loan holders, then to the preference shares and then to the equity. So who bears the loss? Equity share bears the loss first, then the preference share bears the loss and then the loan holders bears the loss. So this 6 lakh rupees, which is not borne by the equity investment, is now going to be borne by other long-term interest, which is as good as equity in a substance. So what we're going to do? So out of this 6 lakh rupee, he bears a loss to the extent of 4.5 lakhs. Because he cannot also bear the loss more than the value of the investment. So he bears a loss of 4.5. So out of this 6 lakh, 4.5 is gone. So the remaining 1.5 lakhs is borne by him. Logically speaking, the losses have been completely absorbed. The 6 lakhs is absorbed 4,50,000 with the preference and 1.5 lakhs by the lenders in this particular case. Okay. So once you've done this, then we will again get the revised values. So once we've done this, we're again going to get the revised values post the step number 2. So let's get the revised values after this step. So this is also the Ind AS 28. So I made 2 columns for step 1. I made 2 columns for step 2. Now let's see the revised value post this. So this becomes 0. this becomes 0, but this is to the extent of 1 lakh rupee. So this is the value of the investments after Ind AS 28. So, but you said 3-step. Where is the third step? The first step is Ind AS 109. The second step is Ind AS 28. And the most crucial is my step number 3 at the end of the table to see if there is any carry forward losses in this case or not. Though in this case, all the 6 lakhs has been allocated towards the other long-term interest, so there is no carry forward of loss. That's just a chance. There is a possibility that the sum total of this investment was, let's say, 5 lakh. And you allocate a loss of 5 lakh, so 1 lakh loss will still be unabsorbed in nature. So right now the carry forward loss is 0, otherwise it could have been 1 lakh. I hope, friends, I stand absolutely clear on my 3-step model in terms of other long-term interest. You're going to make this chart. In step number 1, focus on 109. In step number 2, focus on 28, in the order in which I've given you the allocations. And then step number 3, get the carry forward of losses. This is just year 1 end. We need to go to 2nd, 3rd, 4th, and 5th year as well. Wonderful indeed. So this is the status at, you can say, year 1. Now we're going to make this statement 5 times. My goodness. So it's a long drawn question, but I think this question is going to give you a clarity with which, any kind of permutations can be done. Let's repeat the chart. So we're going to do this chart again at the 2nd year end. So let's make the chart all over again. So I think this time we can take the columns. 1, 2, 3, 4, 5, 6 columns. So name of the securities. And first we'll get the values in the books. 2 columns for step number 1 and 2 columns for step number 2. So we're going to consider the investments. We're going to consider what is the book value of these investments. This is from the previous year. Then we're going to consider the step number 1. We're going to apply the concept of Ind AS 109 and get the revised values. Get the revised values in this case. Then we're going to apply the concept of step number 2. Apply the concept of Ind AS 28. And then we go to the step number 2, get again the revised values in this case. And then in the end, we're going to consider the step number 3 as well. That's going to be the easiest way to tackle the question. So get the book values from the previous year, and then step 1, 109, step 2, Ind AS 28, and step 3, carry forward loss. So we've got equity shares, that is 1. We've got preference shares, that is 2. And we've got long-term loans, that is 3. So these are the 3 inputs with us. So I think let's pick up the inputs from the previous figure. This is nil, nil, and this is 1 lakh. So this is 0, this is 0, and this is 1 lakh rupee. And I would say that, when you note down this column, also see what is the carry forward loss, though in this case it is 0, but just make a note of it. This would make a note of it so that we know a track that yes, there is any carry forward loss or not. Now it gets a little crucial. So now it's going to be a little crucial. Let's get back on the question. Now, in the 2nd year, we can see that there are fair value changes to the extent of 50,000, but there is no impairment loss in the next year. So there is a fair value decrease of 50,000. So in terms of equity, this is not applicable. So there is a fair value changes to the extent of 50,000. And in this case, there is nothing. But now there is a problem. The value of the investment in terms of preference share is 0. And how would I capture the fair value changes to the extent of 50? Because this is 0, I cannot allocate a loss of 50,000 to this particular investment. Now, this is only because we applied Ind AS 28. Had you not applied Ind AS 28, this value wouldn't have been 0. If you just go back and see the inputs, we have captured a fair value loss as per 109, and the book value is 4,50,000. The book value of the investment as per 109 is 450. It became 0 only because of Ind AS 28. So there is, now a conflict which arises, and therefore Ind AS 28 gives us an inputs at this stage. See what? They say now it is time. Now it is time. So let me put it out here very clearly. You should reverse the allocation of loss. You should reverse the allocation of loss as per Ind AS 28. As per Ind AS 28 to the extent of 50,000. So we will reverse this loss to the extent of this 50. Had this value been at least 50, I would have captured the fair value decrease as per 109. So in the year 1, you will now reverse that loss. I'm not going to make a retrospective changes now. Not that I'm going to do any retrospective accounting. The balance sheet is already done. So what we now need to do, we need to reverse the allocation of losses as per Ind AS 28 to the extent of that 50,000 decrease, which means, to put it, in a more clarity, we are now indirectly saying that instead of allocating 4,50,000, we should have allocated only 4 lakhs. Instead of allocating 4,50,000, we should have allocated only 4 lakhs. So we'll just make a mention that we will allocate loss as per year number 1 to the extent of 4 lakhs and not 4.5. So we will allocate the loss to the extent of 4 lakhs and not 4.5. So which means now we are saying that 50,000 losses was not adjusted against the investment. How will this be handled? No worry. So now we can say, coming back to the agenda, so this investment indirectly is going to be recorded at 50. So therefore it will become 0. And this is in any case 0. So we are saying that this 50,000 losses was not allocated. And if it was not allocated, 50 minus 50, this becomes 0. So there is a loss of 50,000 which is not yet allocated. We'll take care of that. Okay. And this, there is no change, so this continues at 1 lakh. So this is the status in terms of step 1, which means the complications which can arise in terms of step number 1 is, if the fair value changes, rather you can say the fair value decrease is to be captured, and this is in contradiction with Ind AS 28, you'll have to reverse the losses allocated in the previous year. In this case, the fair value decrease is 50, and therefore there is a need to reverse the allocation as per Ind AS 28 so that I can book this loss. That's complication which can arise in step 1. Now let's proceed further. Now let's come to the Ind AS 28 losses. Now the losses in the year 2 is to the extent of 2 lakh rupee. The losses in the second year is to the extent of 2 lakh rupees. And equity shares cannot bear this loss. And this cannot bear this loss because the investments are already 0. So which means how much losses can be absorbed now by the long-term lenders? The losses are to the extent of 2 lakhs. But this investment is 1 lakh. So I will allocate 1 lakh rupees of loss. So I think immediately I'm going to write down my step number 3. Would you like to tell me what is the losses which could not be allocated? Please remember, the current year share in loss is 2 lakh rupees, out of which 1 lakh is allocated. And there is a 50,000 loss which has got reversed pertaining to year 1. So what is the carry forward losses to be taken to the third year? Decide and tell me. So what do you say in terms of step 3? What is the carry forward losses relating to the second year? Good, it's 1.5. Because out of the 2 lakh rupees, 1 lakh is allocated, so 1 lakh is pending, and the reversal of 50. So we can say 1 lakh out of the current year and another 50,000 out of the second year. So carry forward losses is 1.5 lakh. So when you calculate the step number 3, you need to see the losses which could not be adjusted in step 2. And if there is anything pertaining to step 1, 50,000 reversal in step 1 and 1 lakh rupees not allocated in step 2, the total carry forward losses becomes 1.5. See, a third step is a very crucial one because this amount is going to be carried forward in the third year to be adjusted there. So now let's get the revised value. So this is going to be 0 itself. This is going to be 0 itself. And this also becomes 0. Right, friends, I hope I'm clear on my thoughts on the second year as well. The complication started in the year number 2. And I think let me just connect the dots. Since the fair value changes are to be captured and the investment is 0, so in step 1, you need to reverse the allocations in the what was done as per 28. So whatever losses were allocated in year 1 will be reversed in the year 2 so that I can adjust that loss of 50. So this losses reversed 50 is a part of the step number 3. Great. Now let's go to the third year. So similar chart now. We're going to go to the year number 3. Let's again make this chart, and we've got 6 columns. So value of the investments as per the previous year, then we take the step 1, then we take the step 2. So this is the investment, and this is the book value of the investment. Then this is my step number 1, where you're applying Ind AS 109, get the revised values. Then you're applying the step number 2, where we're going to consider Ind AS 28, and we're going to get the revised values. And then we'll take the step 3, where we get the carry forward loss. So as you go to the step number 1, take the values and also the carry forward loss. So we're also going to, when you write down the book values, we'll also make a note of the carry forward losses. And the carry forward losses from the previous year now is 1.5 lakhs, which is to be adjusted against the investments in the current year. So let's take care of the equity shares. Then let's take care of the preference shares. And then let's take care of the long-term loans as well. Okay, so now I think we're going to get the information from the previous year. So this is, I think, all 0. So this is all supposed to be 0. The investments are carried at 0. So again, let's go back to the question and see the 109 application. So there is now a fair value increase, by the way. Interesting. There is a fair value gain and there is a reversal of impairment loss. Now, the third year, you start getting some gain. So there is a fair value gain and there is a reversal of impairment loss. So fair value gain is 1 lakh rupee. So in this case, this is not applicable. So fair value gain is 1 lakh and the reversal of impairment loss is 50. Now there is no problem because once you're getting a fair value gains and you're getting a reversal of impairment loss, I don't need to see any unabsorbed losses to be reversed. So in this case, the revised value is still 0. This is 1 lakh and this is supposed to be 50,000. This is the revised values based on 109. Now we'll again go to Ind AS 28 and the losses to be allocated is going to be what? So in terms of step 2, you can say the losses to be allocated. Can I say the losses to be allocated in this particular case is the sum total of 2 things. The losses to be allocated in this case is going to be the sum total of two things. One is the loss at the start. So one is the loss at the start of the year, in which example is 1.5, and the current year share in losses. And the current year share in losses. So you need to remember that in step number 2, the complication is that when you need to allocate the loss, one is the loss which you've written at the very start, 1.5, and the current year losses, both needs to be allocated. Let's go back to the chart. Now, in this particular case, there is no losses in the current year. So since there is no losses in the current year, I just need to allocate the initial loss, that is 1.5 lakhs. So we need to allocate 1.5 lakhs. He cannot bear this money. He bears that 1 lakh and he bears that 50,000 in the given order, and it exactly fits in. Since the losses are 1,50,000 and it's by chance matched with these figures, there is no carry forward of losses to be done. Had this investment's value been below 1,50,000, then there would have been some carry forward losses in step number 3 as well. So I think immediately as you allocate, you got to put down in step number 3 that the carry forward losses now is 0. And I think that will make the life simple again. So now there is no carry forward losses to be taken in the year number 4. It's simple, basic maths. So this is going to be 0, this is going to be 0. So I think instead of writing cross, let's put it as nil. So all these investments have become 0 in this case. All these investments have become nil. Right, friends, I hope I stand clear on the year number 3 as well. So far, so good. It's all systematic. Once you do it by your own hand, you're going to get a complete feel of the inputs. Super. Let's now go to the year number 4. So now we're going to go to the year number 4, make the same chart. 6 columns again. Get the investments, get the book values at the start. Apply the step number 1 and apply the step number 2. So we've got the investments, we've got the book values, and as soon as I note down the book values, I'll see what is the carry forward loss. Now there is no carry forward losses in the beginning of the 4th year as per the chart above, so no losses which are carry forward. So this is going to be step number 1. Applying the concept of 109, getting the revised values. And this is the step number 2, applying Ind AS 28 and getting the revised values in this case as well. And then we will get the carry forward losses at the end after the inputs are done. So I think let's go back to the chart again, get the values. So let's see the values at the previous year. It's all 0. So we've got equity shares, we've got preference shares, and we've got long-term loans. And this is all 0. As per the previous year, this is all supposed to be nil. Okay, now we go to the 109 application once again. Let's go back to the 109 inputs. Now, in the 4th year, there is a fair value gain, but there is no impairment or reversal. So 50,000, and there is a 10 lakh share in the profits. So there is a fair value gain to the extent of 50,000 on the preference shares, and there is no impairment or there is no reversal in this particular case. I think now the life is simple, you know. Once you reach a point where there is no carry forward losses and there are profits, then the life is easy. But now we need to be careful. So let's get the revised values post this application. So this is still 0. This is going to be 50,000 and this is again 0. Now, it's important. The Investors' share in the post-acquisition profits of 10 lakh rupee. Now, this can't entirely go to the equity. So what we need to be careful now is that in this particular case, we can say the share in post-acquisition profits. The share in post-acquisition profits is to the extent of 10 lakh rupee. As we can see, the share in the post-acquisition profits is to the extent of 10 lakh rupees in this case. Now, you cannot give this entire 10 lakhs to the equity because in the previous year, the loans and the preference shares have also been bearing a loss. So now we need to be very careful. So when we were distributing the losses, it went to equity and then to preference and then to the lenders. So the losses were borne in the sequence equity, preference, and loan. Now, if you get a gain, you're going to distribute in what sequence? Loan, preference, equity. So in this particular case, when you get a gain of 10 lakh rupees, so what do we need to do? We need to distribute. We need to distribute in the sequence. We need to distribute in the sequence, and the sequence is first you're going to give it to the lenders, the loan, then you're going to give it to the preference, and then you're going to give it to the equity shares. Because when the losses were given, you gave them to the equity and then to the preference and then to the loan holders. So now the profits will go to the lenders to the extent they bear the loss, then to the preference to the extent they bear the loss, and then comes the equity. So I'm going to first of all go to the lenders and see in the previous year, how much losses have they been given under 28? Let's go back from the year number 1 itself. Let's go back to the year number 1 itself and start calculating the losses they were given under Ind AS 28. Let me use a different color to give you the picture. So we can see as far as the loan holders are concerned, they were given a loss of 1.5 lakhs in year 1. Next, how much were they given in the second year? They were given a loss to the extent of another 1 lakh. So 1.5 lakhs in the first year, 1 lakh in the second year, that makes it 2.5. And then they were given another 50,000 in the third year. So can I say in this particular case, the total becomes 3 lakh. And that means you have given them a total loss of 3 lakhs till date. So you gave them a loss in year 1, you gave them a loss in year 2, you gave them a loss in year 3 as per Ind AS 28. So total losses, which is required to be reversed. So he gets 3 lakhs. This is equal to losses allocated. This is equal to losses allocated as per Ind AS 28. This is the losses allocated as per Ind AS 28 in year number 1 to year number 3. So you have to go back to the chart and see that what was the losses allocated to them in year 1 plus year 2 plus year 3. I hope you got the picture. That's right, 3 lakhs, absolutely correct. Now let's go back and see the inputs in terms of preference. So in terms of the preference, what is the losses allocated? First year we allocated 4.5. But in the second year, we did a reversal to the extent of 50. So allocation of the first year is 4.5, reversal is 50,000. So total losses till now is 4 lakh. And you allocated another 1 lakh in the third year. So that makes it a total of 5 lakh. So 4.5 lakhs allocated in year 1, 50,000 reversed in year 2, and 1 lakh rupees allocated in third year. The total losses allocated till date is 5 lakh rupees. So we're going to take this 5 lakh rupees. This is the losses which are allocated till date. So this is the allocation, which you can say as per the year number 1, 2, and 3. Now, the total share in profit is 10 lakh. So he got 3 and 5, that is 8. So they've got a total of 8 lakh rupees. So what is the remaining balancing figure? So we can say out of the 10 lakhs, 8 lakhs has gone to the other parties, so he gets 2 lakh. Wow. So now what we've done, earlier we were allocating the losses in the sequence of equity preference loan. Now we are allocating the gains in the sequence of loan, preference, and equity. I hope, friends, I stand clear on my thoughts. So this revised value is going to be 2 lakhs. This revised value is going to be 5.5 lakhs. And this revised value is going to be 3 lakhs. And of course, we need to keep a track in terms of step 3. Carry forward losses. That's a crucial point. Though in this case now there is no carry forward losses. But imagine that in this particular case now, if he would not, let's say if these two people would not have got the entire compensation, next year you will have to allocate something more till the point of time. Till the point of time he gets that 3 lakhs back, till the point of time he gets that 5 lakhs back, he cannot get a single penny. In this year, you could reverse, you could give them the entire share in losses. But if you're not able to give them the entire share of losses, he's not going to get a single penny till that particular point of time. Okay, so I think let's still make a mention of the step number 3 as well. So in terms of the step number 3, that is carry forward losses. The carry forward losses in this case is now 0. Now let's go to the year number 5. Wow. So the question has taken a huge time. I think we spent almost like 1 hour doing this particular question, but it's a beautiful question. Let's go to the year number 5 now.
45 minutes.
45 minutes? Really? Okay. Once we started the question earlier, we were talking about the concept. Correct. So I think this question can be easily, a 16 marker, 14 marker question in the exams, considering the timing factor, I guess. So these are 2 columns. Then step 1 got 2 columns. Step 2 has got 2 columns. But trust me, if you go step by step, it's not going to be difficult at all. If you go with the sequence that I'm applying 109, then I'm applying 28, then I'm looking at the carry forward losses, the crucial points in step 1, that there is any reversal required, the crucial point in step number 2, and the carry forward losses, then I think it's not that bad. So investments, book values, then we look at step number 1, index 109, get the revised values. And then the step number 2, index 28, and getting the revised values again. And step 3 will come at a later stage. So let's fit in these values. So we've got equity shares, preference shares, and the long-term loans, and the long-term loans in this case. So let's get the values from the previous column. This is 2, 5.5, and 3. So this is 2 lakh, this is 5.5, and this is supposed to be 3 lakhs. And I think least we forget, we'll also pick up the carry forward losses from here, and the carry forward losses out here is 0. I think it's important to keep tracking the carry forward losses in this particular case as well. Okay, now in this particular case, we are going to go back to the chart, see the status of 109. So now we see the fair value changes are 30, there is no reversals, no impairment, and the gain is 10 lakh rupees again. So 30,000, that is the fair value change in terms of preference share. So this is not applicable. There is a fair value gain of 30 and there is nothing out here. So this, the revised value is 2 lakh. This is 5.8 lakhs and this is supposed to be 3 lakh. Okay, so this takes care of the step number 1. Then the post-acquisition shares are 10 lakh. So we've got the post-acquisition share The post-acquisition share in this case is 10 lakh. I think now let's ask you a question. Is there anything to be given? Is there anything to be given to the preference and the long-term loans, or they are over? Whatever losses were allocated to them under 28 stands reversed in year 4. Correct? That's right. So in this particular case, they are not to be given anything, so they will not get anything. So the entire 10 lakh goes to him. So we can get the revised value. This is 12. This is 5.8. And this is supposed to be 3. And then we can get the step number 3 as well. And if there is any carry forward of losses, nothing. So there is no carry forward of losses which is pending in this particular case. Wonderful. So I think all the 5 years is taken care. So the question was asking us to calculate the value of investments at the end of each year, all the 5 years done. So far, so good. So I think I'll just make a quick check on the calculations. This is the answer. I'm just going to make a check whether the answers are correct. Are we getting these values? Just make a check. Are we getting this 12 lakh, 580 and 3 lakhs at the end of 5th year, right?
Yes, sir.
Great. Wonderful indeed. Okay, so that's, I think, done with the inputs. Ind AS 28 gets over on that. Super. So now we're going to go to the next standard, that is Ind AS 111, that is joint arrangements. I think I'm going on the right track. I am going to get some time because as I promised that in the next class, I want to do a comprehensive question on a consolidated balance sheet and on a consolidated P&L, which has got some more adjustments, more than what we've discussed, including the impact of deferred tax. As I said, I'll see that if I'll get managed time, I think I should be able to get some time. And we're going to do those comprehensive questions with you, which contains almost all good level of adjustments in a balance sheet with the subsidiary, with the associates put together. Okay, so let me first, I think, begin with the inputs on 111 now. So now let's come to the inputs in terms of Ind AS 111. Let me just, I think, crop this first. So now we're starting with another standard on consolidation, and that is joint arrangements Ind AS 111. I've been dividing all these standards in 3 blocks. If you remember, the sequence of thoughts is simple. When it came to Ind AS 110, I said scope and the control assessment. Then I went to the consolidation procedure. And then I came to the block 3, changes in the ownership interest. When I came to Ind AS 28 also, I created 3 blocks, and that was again the scope and the assessment of significant influence. Then I came to the equity method of consolidation, and then the 3rd block, that was the appendix D, which is other long-term interest in the associate and the JV. I'm going to divide Ind AS 111 also in terms of 3 blocks. But these 3 blocks is going to be slightly different, but something similar. The first thing is that I need to see that is it a joint arrangement or not. And when I see that is there a joint arrangement, I am also going to look at the assessment of joint control. So my block number 1, I'm not going to discuss the scope in this case, but I'm going to basically discuss the assessment of a joint control, that whether it is a joint arrangement, block 1. The block 2 is, once you say it is a joint arrangement, is it a joint operation, JO, or is it a joint venture, JV? So my block number 2 would be classifying the type of the arrangement. Is it a JV or is it a JO? And then the block number 3, we will look at the accounting. So a little different sequence, but get the thoughts clear. The first is assessment of a joint control. Is it a joint arrangement? The second is the type of joint arrangement, JO or JV. And the third is the accounting of a JV that gets shifted to 28, but basically the accounting of joint operations in the separate and in the consolidated financials. I'm also going to give you a connect between Ind AS 27 now and in terms of the consolidation standard. So I'm going to take that Ind AS 27 also in my discussions in the standard. So I think let me do one thing first. So I'm going to first of all divide the standard into 3 blocks. So we're looking at Ind AS 111. The name of the standard is called joint arrangements. The name of the standard is called joint arrangements. So as I said, we'll divide this in a 3-block discussions. So the block number 1, what we're going to look at in this standard is the assessment of joint control. We're going to learn the aspect of assessment of joint control, or typically whether it is a joint arrangement. So we will see that is it a JA? So I'm putting this as JA. Is it a joint arrangement? So the assessment of joint control will lead us to the conclusion that is it a joint arrangement or not. Then the block number 2. Then in terms of the block number 2, we will decide on the type of joint arrangement. And the type of joint arrangements would be either a joint operation or a joint venture. So this is called a joint operation. So what are the parameters which will help us to decide that it is a joint operation or it is a joint venture? So I think at this stage, let me also make a clear-cut mention, though we have said that earlier as well. The moment you say it is a joint venture, its accounting is covered by 28. Its accounting is covered by Ind AS 28. And that's what we said, accounting for interest in associate and JV. So the moment you decide that the joint arrangement is a JV, you're out of the standard. And then comes the input in terms of block number 3. Then comes the input in terms of block number 3, which is on the accounting, typically of a joint operation, and that is in the separate financials and in the consolidated financials. Now, there's something which I think I should definitely clarify. I'll document this later, but I think let me clarify this. When it comes to a subsidiary or an associate, the accounting in separate financial statements is as per Ind AS 27. Mind the words carefully. As an investor, you've got subsidiary, you've got associate, you've got JV. I'm not saying JO. I'm not saying JO. So as an investor, you've got investment in subsidiary, associate, and JV. You are going to account for those investments in the separate financial statements as per Ind AS 27. But if you've got a JO, the accounting is not covered under Ind AS 27. The accounting is covered under Ind AS 111. So be careful. I will make a chart very soon telling you that in different circumstances which standards will trigger. If you look at 2 financial statements of the investor, one is the separate financial statements and one is the consolidated financial statements. If you've got a subsidiary, if you've got an associate, if you've got a JV, then separate is 27. And for consolidation, subsidiary 110, associate 28, JV 28. But when it comes to a JO, the separate and the consolidated financial statements, both as per 111. Don't worry, we'll document that later, but I just want to pen the thoughts down. Okay, so this is the 3 blocks arrangement. Let's now begin our inputs in block number 1. So we're going to decide our inputs now in terms of block 1. So we're looking at the assessment of joint control, or you can say basically deciding that it is a joint arrangement, though where the basic input is assessment of a joint control. Now, let me, I think, give you a very simple thought process of deciding when is an arrangement supposed to be called as a joint arrangement. So let's give you the thoughts. When I say it is a joint arrangement, you need to first of all prove that it's a contractual arrangement. When you say that a given arrangement is a joint arrangement, the first thing is what you need to prove that it's a contractual arrangement. Now, what is a contractual arrangement? Two or more than two parties enter into an arrangement, maybe in writing or maybe in oral. So we can say, when you say it is a contractual arrangement, we can say two or more than two parties. Two or more than two parties enter into an agreement. Enter into an agreement. So when they enter into an agreement, so when we say it's a contractual arrangement, minimum of two or more than two parties enter into an agreement to act jointly. So they enter into an agreement to act jointly. So the first thing I'm going to see, if it is a joint arrangement, I'll say, okay, is there a contractual arrangement? Have the two or more than two parties entered into an agreement to jointly act together? If you say a yes, then I'll say the second one is to see that there is a joint control. The second one is to see that they've got a joint control. So per se, when you say there is a joint arrangement, you are going to put two questions. Number one, is it a CA, a contractual arrangement? Then you're going to put the second question, is there a GC that is a joint control? Now, when you say that there is a joint control, the joint control is got two elements. When you say that there is a joint control, the joint control has got two elements. Let me say something and vouch me on that. Then I'll do some combinations working on them. I cannot take decisions alone. Number one, you have to decide and tell me the difference in the two sentences. I cannot take decisions alone. I need to take the consent of other people. That's one. They cannot take decisions without me. They also need to take my consent. Are these two things same or are these two things different? Hear them again. I cannot take decisions without taking consent of those other parties. Number one. They cannot take decisions without taking my consent. Is this one and the same thing or they are two different things? Seems to be similar. Okay, so I think let me put it like this.
Different things, sir.
Yes, they are different things. I think I'll elaborate that.
In one case, I am deciding, and in another case, they are deciding.
It's like, that if I say I cannot take a decision without you. So let's put it in a very simple manner just to understand the concept. So let's say, I want to decide the timings of the class. So I cannot take the decision without asking you. That's one part. And you also cannot tell me that the class is going to happen at this time. You need to listen to me and I need to listen to you. Now you would say, is it possible that, I need to listen to you, but you don't have to listen to me? Yes. It's possible. I'll take examples later, but it's possible. So the concept of joint control is based on two things, that when I am taking a decision, I can't take independent decisions. I have a dependency on the other parties. Same way, it should be a two-way traffic. When they take a decisions, they also cannot take decisions alone. They also need to take my consent. So it is quite possible that when I need a decision, I say, you say a yes, then we go ahead. But when they want to take a decision, they don't need my yes. They take decisions independently. So the standard says, in terms of a joint control, there are going to be two elements. There are going to be two elements. So I'm going to put that as a question. There are going to be two elements in this case. And let me put this as a simple little question when I'm going to decide this. So I will put this as collective control. I'll call this as collective control. And what is the question? I'll give it across to you. And the second one is what we call unanimous consent. The second one is what we call a unanimous consent. And let me illustrate this. So when I say a collective control, that's what I call CC. That's what I call CC. And unanimous consent is what I call UC. And the contractual arrangement is what I call CA. So when I say collective control, it means as an investor, I cannot take decisions. I cannot take decisions alone. As an investor, I cannot take decisions alone. So I don't have a control. I don't have a control because I need to listen to other people so we collectively get a control. I can't take decisions alone. And when I say it is a unanimous consent, it means other investors. It means other investors also need my consent. So they also need my consent. Unless I also agree with them, they also cannot take a decision. I'll give you an example very soon where you will see that I can't take decisions without other people, but they can take decisions without me. I have a dependency, but they don't have a dependency on me. So if that be the case, there is no joint control. For a joint control, it has to be a two-way traffic. A two-way traffic means I can't take decisions without you, you can't take decisions without me. We have got a complete interdependency. Any of the factors is missing, there is no joint control. So moral of the story, if I were to decide that it is a joint arrangement, step number one, is there a contractual arrangement? Step number two, is there a collective control? And step number three, is there a unanimous consent? That makes my three-step model. So when you go to assess a joint control, and here again you can see the joint control assessment is not a rule-based assessment. It is not based on any kind of percentages in this case. The assessment is again based on the criteria of a principle-based assessment. You can see nowhere any percentages are defined. And in this case also we're looking at, is there a contractual arrangement? The two or more than two parties decided to act jointly. And I cannot take decisions alone. I'm a part of the collective control. And they cannot take decisions without my consent. They need a unanimous consent. If all the three elements are present, it becomes a joint arrangement. Let's, I think, document this formally in a three-step model. But I hope I stand clear. Great. So let me now document this in terms of a three-step model. Let's document this in terms of a three-step model. In step one, we will say, is there a contractual arrangement? The first thing is we're going to ask ourselves a question that is there a contractual arrangement? So we're going to first of all ask ourselves a question that is there a contractual arrangement? Now, when I say that there is a contractual arrangement, it means two or more than two parties. Two or more than two parties enter into agreement. So two or more than two parties have entered into an agreement. So you need to decide that two or more than two parties have entered into an agreement. So the answer would be a yes or a no. The answer would be a yes or the answer would be a no. If you say that they have not entered into the agreement, then we can say the standard is not applicable. Because without the presence of a contractual agreement, the standard does not trigger. And if you say a yes, we go to step 2. Now, in terms of the step number 2, we're looking at, is there a collective control? So second step, we're looking at, is there a collective control? So we're looking at a collective control. So when you say that we're looking at a collective control, as I said earlier, collective control would mean that I cannot take decisions alone. I cannot take decisions alone. I am dependent upon the other investors. Unless they say a yes, I cannot take decision. Because if I am able to take decisions alone, I get a control. Then it is Ind AS 110. So when you say, is there a collective control? The answer is a yes, or the answer is a no. If the answer is a no, the standard is not applicable. But if you say a yes, we go to the step number 3. Step 2 and 3 is a part of the joint control assessment. Then in terms of the step number 3, we'll say that is there a unanimous consent required? Is there a unanimous consent required? So we will put across a question that is there a unanimous consent which is required? Now here again, when I say a unanimous consent, unanimous means other investors. Other investors cannot take decisions without my consent. They cannot take decisions without my consent. So unless I give my consent, they also cannot take a decision. So the step number 2 proves I am dependent upon them. The step number 3 proves they are dependent upon me. I can't take decisions alone. They can't take decisions without me. So there is a unanimous consent. So in this particular case, we will again get the answer yes or a no. So if you get a yes, I would say it is a joint arrangement. And if you say a no, the standard is not applicable. Wow, that I think gives us a 3-step model in terms of taking a call that whether it is a case of a joint arrangement or not. We can now take some small little questions, which I'm going to create. Then we'll go back and see some questions in the study material as well. But I guess so far so good. I hope you got the dots connected. The assessment of a joint control, or indirectly the broader picture, assessment of a joint arrangement, JA. Okay, let's begin. I'm now going to create some permutations, combinations for a better clarity. And I am going to consider 2 blocks. One block, I'm going to consider 2 parties. And another block, I'm going to consider 3 parties. So let's consider there are 2 parties in an arrangement. And let's consider that there are 3 parties in the arrangement. So we'll take, 2 different blocks. One is considering 2 and one is considering 3. Now, let me also tell you one thing. Right now, in this particular chart, I am considering that the joint control is based on the voting power. It is quite possible that the joint control is not based on a voting power, but the joint control is based on, you can say, the appointment or removal of the KMP. So the joint control assessment can be on the basis a company takes a decisions on the basis of majority voting rights. So your joint control assessment is based on a voting power. But sometimes the decisions are taken by the board of director. So then it depends how many board of directors can I appoint. So in my assessment right now, we are considering the voting power as a base. But it can also be based on the appointment and the removal of the KMP. So it all depends. The decisions are based on voting power or the decisions are based on, you can say, the representation of the board of directors, accordingly, the assessment will be done. Right now, I'm assuming that the assessment is purely based on voting. Now, let's give you some inputs and let's decide. Now, let's say there are two parties, A and B. A has got, let's say, a 50% stake and B has got a 50% stake, and to take decisions. Let's say we need a 75% majority. Can I say there is a joint control? What do you say? Every decisions would need 75% majority. Now put across a question to yourself. Can A or B alone take a decisions? No. Can B take a decision without A? No. Can A take a decision without B? No. So can I say they can neither take independent decisions? That means they're part of the collective control. And none of them, can take decisions without each other as well. So I think this is what we can say is an implied joint control in this case.
But there is no agreement as per you.
Okay. I'm assuming that there is a contractual agreement in all the cases I'm going to handle. So we're just going to make the assessment of joint control. Agreement is there, implied. So I think I'll give the assumption at the beginning just to avoid any confusion. So my assumption out here is that let's say there is a contractual agreement. So I'm assuming that the contractual agreement is in place. Can I now say that there is an implied joint control, correct?
Yes, sir.
Great. Let's give you another combination now. So this is one. Let's give you another one. Now, let's say this is the same percentage, but I need majority to take a decision. Will the status change or is it implied joint control again? I'm not going to make a strong statement, react to that. Can I say if two investors have got equal percentage, it is an implied joint control always. Agreed? If there are two investors with an equal percentage, there is always an implied joint control, because either you need a specified percentage, like example 75, or you need a majority. In either cases, I think it's always going to be an implied joint control. You said a no? Think. If they need a 75, they can't individually achieve 75. They need a majority, they can't individually achieve a majority either. Which means that if there are two investors with an equal percentage, I am thinking it's always an implied joint control. Agreed? I think yes. That's right. Okay, let's give you another input now. This was based on equal percentage. So this is based on equal percentage. Now let's take unequal percentage. Let's consider an unequal percentage in this case. So let's consider the combination. It is 60 and it is 40. We need a 75% to take a decision. Is it implied joint control? Can
Yes,
anyone take independent decisions? No. Are they interdependent? Yes. Implied JC. It is again an implied joint control. But if I change the combination that
no.
Instead of 75%, we need a majority. Now what?
No.
That's right. Can I say in this particular case, it was implied, but if it is majority, can I say A has control? So I think I can now make some, implied inputs based on the permutation combination. I'm saying if there are two investors, that's my presumption. If there are two investors with equal percentages, always JC. Agreed?
Yes, sir.
Yes. And if there are two investors with unequal percentage, then depends. They may get a JC, they may get a control, all depends upon the percentage requirement. Correct? So I don't think so that there will be any other permutations, combinations coming in terms of the two parties. Now let's come to the three parties. Let's consider now the case of three parties, A, B, C. Now it's time to give you the inputs where the unanimous consent can be missing. Let's consider the first combination. A has got 50%, B has got 30%, and C has got 20%, and we need a 75% to take a decision. Now let me ask you something about A and B. Can A or B take independent decisions, or even C take independent decision? No. But can A and B take decision without C? Yes. Can I say C has got a 20%, A and B combined can easily achieve this percentage? So let me put a question now to you. Can C take independent decisions? No, is a part of the collective control. Do other people need his consent? Yes or no?
Whose consent, sir?
Does, if I'm looking at C's point of view, does other people, that is A and B, do they need his consent?
No.
No. So which means he cannot take decisions alone. He's a part of the collective control, but other people can take decisions without him. So he's not got a joint control. So in this example, we can say, as far as joint control is concerned, A and B gets a joint control. And C, in this case, we will have to assess that there is no joint control, but maybe he's got a significant influence. So maybe he ends up applying Ind AS 28. If one investor gets a control, another investor can get a significant influence. If two investors have got a joint control, the third investor can get a significant influence. So in this particular case, C cannot apply Ind AS 111. He can only assess a significant influence. If there is a significant influence, he would apply Ind AS 28. Though, interestingly, if they classify this arrangement as a JV, A, B, C, all the three will end up applying Ind AS 28 effectively. Because a joint venture will get shifted to 28. So if it is a joint arrangement and it gets classified as a joint venture, A and B having a joint control will apply 28. C having a significant influence, calling it as an associate, would also apply Ind AS 28. Let's look at another combination. Now let's consider this is 50, and let's consider this is 25, and let's consider this is 25%. And I need a 75% majority to take a decision. Now we can clearly see that nobody individually can take decisions independently. They are all part of the collective control. But now let me ask you something. If A and B join together, can C stop them? No. If A and C join together, can B stop them? No. So can I say A and B can achieve a combination? A and C can achieve a combination, which means A and B join hands, then they don't need the consent of C. If A and C join hands, then they don't need the consent of B. The standard now says very clearly that if there are two or more than two combinations achieving a joint control, it should be clearly documented in the agreement that whose combination will work. If they do not mention that in this agreement, none of them has got a joint control. None of them can apply Ind AS 111. So I think in this case, let's put a note. Since two combinations, one is A plus B and one is A plus C, can achieve a joint control unless there is a written agreement. Unless there is a written agreement. So unless there is a written agreement as to which combination is valid. Ind AS 111 will not be applicable. Ind AS 111 will not be applicable. So Ind AS 111 will not be applicable in this particular case. Wow. So the agreement between the parties should clearly make a mention of the same. So if you can achieve this combination with various permutations and combinations, the standard makes it very clear that in the agreement, it should be written that A and B have got a joint control or A and C have got a joint control. If they do not document this in the form of written agreement, there is no joint control. None of the parties will be able to apply Ind AS 111. In this particular case, they will all make a significant influence assessment, and if there is significant influence, they will apply Ind AS 28. Right, so I think that gives us three-party status as well.
So basically, A will decide whether he will combine with B or with C in terms of an agreement.
Yes, but then that there should be a written agreement to the consent. If there's no written agreement between A and B, then nobody has got a joint control, not even A, not even B, not even C.
Thank you.
You're welcome. Okay, so I think this gives me the input in terms of block one. Now we need to do some questions on the study material. So let's, I think, take some few questions. Again, to reiterate one important input, in this particular case, the concept of joint control is being considered on the basis of voting power, but there could be cases where the decisions are taken by the board of director. Then your decisions will be on the appointment and removal. So accordingly, we'll have to see the facts of the case. So let's, I think, go to some questions with you. Let's have a look at a few questions on the study material. I'm coming to illustration number 1. So a couple of illustrations are there on the concept of joint control. So we'll quickly run through majority of these things. I think there are a lot of illustrations, so I'll not go through each one of them, but I think at least some few typical illustrations we're going to go. So I think there are around 10 illustrations on this area. I think so. No, it's more than that. So we'll not go through every illustration. We'll just quickly run the inputs in this case. Yes, there are around 12 illustrations. Let's, I think, first begin with a few illustrations, then maybe we'll take a break in between and then carry forward further. Okay, so let's, I think, begin with the illustration number 1. It says ABC and DEF have entered into a contractual arrangement, very clearly given, to manufacture a product and sell it in the retail market. As per the terms of the arrangement, decisions about the relevant activities requires the consent of both the parties. The parties share the returns of the arrangement equally, whether this can be treated as a joint arrangement. Well, I think in this case, since we are very clearly given that all the decisions require a unanimous consent, I'm not given any percentages. I believe, yes, there is a joint control. So it is a joint arrangement because, first of all, there is a contractual arrangement. That's one. Decisions about relevant activity require a unanimous consent. So assuming that there is a collective control as well as there is going to be a unanimous consent, I think it's a joint control. Let's now look at illustration 2, which is a little more easier. PQR XYZ established an arrangement in which each has got a 50% voting rights. And we need at least 51% voting rights to take decisions. So if I'm just looking at a joint control, can I say implied joint control 50-50 and we need 51%, correct?
Yes, sir.
Yes, so there is implicit joint control in this case, similar to my example that was there in terms of two-party. Next, it says ABC established an arrangement where A has got a 50%, B has got a 30%, C has got 20%, and we need 75% voting rights. I think that's similar to my 3 example. So can you tell me who gets a joint control, ABC or AB?
AB.
That's right. A and B are going to get a joint control in this case. Okay, so in this particular case, we can clearly come to the conclusion that A and B will get in contractual. So we can say A can block any decisions. And then I think I'm just putting it out here. It implies A and B have a joint control. C is not a party to the joint control arrangement. Let's come to the illustration 4. X has got 50%, Y and Z have got 25%. Now, this is also what we have done. So can I say in this case, the agreement needs to be clear. So in this case, even then, I'm just running it fast. X, Y, Z collectively control. However, there is more than one combination to reach that 75%. In such a situation, to be a joint arrangement, the contractual arrangements need to specify which combination is required to agree unanimously. As I said, you need to make an explicit mention that which combination will work. If you do not specify which combination works, Ind AS 111 cannot apply. Okay, let's go to the next one. An arrangement in which A and B have 35% and the remaining 30% is widely dispersed, and we need a majority to take decisions. Is this also resulting in more than one combination? A and B 35, 35, 70. A and the widely dispersed 65. B and the widely dispersed 65. Is the status of this same as illustration 4? Except that now the 30% is not held by one investor, but it is widely held. Would that
No.
make a difference to my analysis? No.
Yes.
No, it will not make a difference to my analysis. The answer would still remain the same. So
No.
in this case, again,
Since it is
yes.
widely dispersed, sir, how can others reach the similar combination, sir?
Okay, you see, the thing is that you'll have to look into the practice in terms of, the historical experience that people are actively participating in the meetings, and those other people, are actually having an agreement with me that we act together.
No,
So I
but it
know
is
it's a
not
different
given.
combination, but I think still the specification needs to be done. This is an example given in the standard also, which says that, in the previous illustration, there are three investors. Now, even if there are two major investors widely dispersed, you can still achieve a combination with A and widely, B and widely. So combinations is more than one technically in this case. So in the given days, decisions require approval. So it says there is no joint arrangement. You can see the inputs. A and B have a joint control only if the contractual arrangement specifies the decision. Can you see that? So if A and B have made a clear-cut specification that our combinations is going to achieve a joint control, otherwise, if they do
Correct.
not enter into
Correct,
this
sir.
arrangement, it's not joint arrangement. So in this particular case, I think the same assessment which I
Correct,
said.
correct, sir.
Right, great. Okay, so this is done. So this was based on the concept of a voting power assessment. As I said, the joint control assessment could be a voting power assessment, or it could also be based on the representation on the board of director. But I think that part we'll discuss after the break. We're still on the block 1 doing an assessment of joint control, but assessment of joint control on the basis of voting power is done. Now we're going to see the representation on the board of directors, and then we'll go ahead to the block number 2. But I think first time to give you some break, 10-12 minutes, and then we start back again. Enjoy your break. ब्रेक लगा दीजिए। I hope you had a relaxation of mind. So we were talking in terms of assessment of a joint control, and we've covered the aspect of voting power as a base to assess the joint control. Now we're going to look at more combinations, and that is when the basis of joint control is supposed to be, you can say, the representation on the board of directors. Then what happens? Well, I would say basically when you're looking at the representation on the board of directors, so it's like, if there are, let's say, 4 directors to be appointed, and each of the investors can appoint 2 directors. Naturally, the majority would need that unless at least 3 out of 4 agree, there cannot be a joint control. But there can be certain exceptions as well, and that is called, the casting vote of a chairman. We will see that in a practical illustration. So I think let's have a look at the illustration 6. Now it says electronic is established by 2 investors R and S, and the investors have got 60% and 40% voting power. But now see what the inputs are given. Articles of association, both the investors have the right to appoint 2 directors each on the board. The directors appointed by each investor will act in accordance with the directions of the investor who is appointed such a director. Further, the articles provide that decisions about relevant activities will be taken by the board of directors through simple majority. So, a very crucial question. They've got a 60 and a 40% voting power, but decisions on relevant activities is taken by the board of director. So is the assessment of a joint control voting power based or representation on the BOD?
Representation on BOD.
Absolutely makes sense. So in this case, since they can appoint 2 directors each, I think nobody has got a majority. So in this case, is it controlled by a single investor or jointly controlled? I would say definitely jointly controlled, because if you need to reach a majority, then out of 4 directors, at least 3 should reach a consensus. So 2 will say yes on behalf of one investor, and another 2 will say a yes on behalf of the other investor. So at least if 3 agree, decisions cannot be taken. So it's again a case of a joint control. I think I'll just put it out here. Electronics is jointly controlled by both investors. Let's look at the illustration 7. It says MN is established by 2 investors and they've got 50% voting power each of the investee. As per the articles of association, both the investors have the right to appoint 2 directors on the board. The directors appointed by each will act in accordance with the directions of the investor, and the decisions are taken by the board of directors through simple majority. I think the facts of the case so far are same as the illustration number 6. Then he adds on further inputs. It says articles of association. So it says the articles of association provide M has got the right to appoint the chairman of the board, who will get the right of casting in case of a deadlock situation. Now, this is an addition in terms of the previous illustration. One of the investors have got the right to appoint a chairman, and when there is a deadlock, the chairman will decide. So do you think the chairman will listen to the investor who has appointed him? Of course, yes. So can I say in this case, would there be a joint control, or can I say since M has got the right to appoint the chairman who's got a casting vote, he gets a control?
M gets the control.
Correct. So therefore, M individually has a power and there is no joint control. I would say this would be a case of a control by the investor M. Okay, let's look at another illustration 8 as well. ABC established by 2 investors, each has got a 50% voting power. As per the article of association, AB and BC have the right to appoint 3 directors and 2 directors respectively. So in this case, it says the directors appointed will act in accordance with the investor. Further, articles of association say that decisions about relevant activities taken by simple majority. So what do you say? Control by
A,
AB or
A,
joint control?
A has got control.
Yes, AB has got a control because in this case, again, he can appoint 3 directors and the other person can appoint 2. He got a simple majority. So I think I'll just read the answer. ABC is not jointly controlled. In this case, we can say AB can take decisions independently without the consent. So I'm not doing all the illustrations, but I think the majority ones I've taken. Okay, maybe 2-3 illustrations you can do. Okay, but I think I'll just like to add one more illustration, which is interesting. I think the illustration number 11. So let's look at the illustration number 11. It says entity has got 4 investors with 10, 20, 30, 40% voting power. The articles of association require the decisions to be taken by majority voting rights. However, investors ABC have informally agreed to vote together. This informal agreement has been effective in recent meetings to take decisions. Now the question rises, can this informal agreement be construed as a basis to assess a joint control? And the clarification is yes. So this illustration only gives us the input. The 3 investors have informally agreed and they've also done this in the past. So we can say they do get a joint control over the entity. The agreement, it says, need not be formally documented as long as there is evidence of its existence in the recent meetings of the investor. So I think this illustration throws a light in terms of informal arrangement between the investors to act jointly, which is evidenced by their acting together in the recent meetings is evidence enough that there is a joint control. So my block number 1 is over, assessment of a joint control. Now we go to block number 2. So now we're going to go to the block number 2. So my second input now in terms of block number 2 is on deciding the type of joint arrangement. It is now deciding on the type of joint arrangement. So let me give you a thought process. You know, the standard is divided in a 3-step model. Within the step 1, we got a 3-step model. Now within the step number 2, also we're going to get a 3-step model. Oh my God, so many 3-step models in between. 3 blocks in the entire standard. The block 1 is a 3-step model. Now the block 2 is also going to be a 3-step model. For this purpose, there is a very interesting chart which is given in the standard. So I think I'll just like to take you to the chart. It's also in the study material. So let's have a look at this chart. This is going to give us the inputs with which we will decide. So there's one more inputs to be given. There's another chart. I think we'll first look at that chart and then go further. So this is the summary chart, which is also given in the standard also. And it's also there in the study material also. I guess may not be too much visible, maybe. No worry, we'll make some notes on that, don't worry. It says we need to look at the structure of the joint arrangement. The standard says we need to look at the structure of the joint arrangement. If it is not structured through a separate vehicle or it is structured through a separate vehicle. So I think let's first understand one very important input. 2 entities A and B enter into a joint arrangement. The very first question which you're going to put across is, did they create a third entity? You call this as a separate vehicle. So did they create a new company? So let's say, for example, A and B enter into an arrangement and they created a new company, let's say AB. So I would say they created a separate vehicle. Or they do not formally create a separate vehicle. They plan to continue this arrangement with the existing companies itself. The standard makes it very clear that if they do not structure a separate vehicle, it's always a GO. So that's what the standard very clearly says, that if you do not structure this, it's a joint operation, point blank. So the first test which you need to apply in terms of deciding the arrangement is a JV or a GO is ask a question, did they create a separate vehicle? If you say no, they did not create a separate vehicle, it's a joint operation, done. But if they create a separate vehicle, then I would say we need to apply a three-step model in terms of deciding this. Now, there are three parameters. It may not be much visible, but don't worry, we'll make notes on that. It says the first step is to look at the legal form. The second is to look at the terms of the arrangement. And the third is to look at the relevant facts and circumstances. So let's get the chain very clear. I'm going to first of all ask that, did they create a separate vehicle? If you say no, it's a JO. If you say yes, apply a three-step model. Now, in terms of three-step model, the step one is called legal form. What is it? We'll see. The step number two is called looking at the terms of the contractual arrangement. And the step number three is looking at the relevant facts and circumstances. Now, let me expand this further in terms of deciding. Let's come back on the chain. So I'm going to first of all put a small little question. Was a separate vehicle created? Was a separate vehicle created? So did we create a separate vehicle or not? Did we create a separate entity or not? So if you say no, it is going to be a joint operation decided. If you say a yes, we need to take a decisions and apply a three-step model. So we'll have to take a decisions and apply a three-step model. So this is the basic chain of thought with which we will classify the type of joint arrangement. Now, let's work upon the three-step model. Now, hear me very carefully. So I'm going to give you the chain of thought which we need to apply in terms of the three-step model. Step number one, step number two, and step number three. The step number one is what is called legal form. If we created a separate vehicle, we need to ask ourselves a very simple question. What is the form in which a separate vehicle is created? Did you create a company? Did you create an LLP? Or did you create a normal partnership form? So I'm just going to put a very simple question to myself that when you say you established a separate legal entity, I would say, okay, did you create a company? Did you create an LLP? Or did you create a partnership firm? Now, when I say it is the legal form means that we need to ensure that the parties to the arrangement and the separate legal entity, the separate vehicle established, are they separate legal entities or not? So, as I said, the chain of thought is when you say the legal form, I'll say, okay, what did you establish? Did you establish a company? Did you establish a limited liability partnership, or was it a simple partnership firm? Now, when you establish a company or when you establish a limited liability partnership, the members of the arrangement and the separate vehicle always have a separate legal entity. So the legal form is looking at what is called that we need to ensure that there is a separate legal entity concept. We need to ensure that there is a separate legal entity concept which is getting established. So when you establish a company, we can easily conclude that the parties to the arrangement and the separate vehicle are definitely separate legal entity. Same goes for an LLP, but in a normal partnership firm, the partners are not different as compared to the partnership firm. So in this case, the legal form is established, separate legal entity, but in this case, the separate legal entity is not established. So your first focus will be to see that when you created a separate vehicle, what is that separate vehicle? If it is a company or LLP, then we can say, yes, a separate legal entity is got established. But if it is a partnership firm, we'll say separate legal entity is not established. So in these cases, we will say it is a joint venture. And in this case, we will say it is a joint operation. So how the vehicle is being structured will decide whether it is a JV or it's a JO. So when you ensure that a separate legal entity gets established, JV. When there is no separate legal entity, it is JO. But now, irrespective, whatever you decide in step number 1, you have to go to step number 2. Get this very clear. Irrespective of whatever you decide in terms of step number 1, we will definitely go to the step number 2 as well. Now, what we're going to do in terms of step number 2, we will look at the terms. We will look at the contractual terms. We will look at the contractual terms of the arrangement. Now, what I'm about to tell you might sound a little funny and might sound something, how is that possible? The parties to the arrangement enter into a contractual agreement whereby they override the separate legal entity concept. So, but how is that possible? How can the parties to the arrangement violate the principle of separate legal entity? Well, they can. Now, whether it's legally possible or not, I'm not going to get into all those details, but the standard says, please ensure that if there is a contractual agreement between the parties, are they trying to violate the separate legal entity concept? But how do we assess that a separate legal entity concept is getting violated or not? You need to see, in this case, I would say, 2 things. When you look at the terms of the arrangement, we will see, are the parties getting a share in the asset, liability, income and expense, or are they getting share in the net assets and the net profits of the separate legal entity? So the parties to the arrangement have got rights to net assets, net profit, or they've got rights towards asset, obligations towards liability in a different percentage, rights in the income and the obligations towards expenses in a different percentage altogether. So in this particular case, if you say that they are getting a right to the asset, liability, income and expense, it is going to be a JO. And if you say that they're going to get right in the net assets and net profits, it's a JV. So can you just connect the step number 1 and 2 again? Let me do that. Let's say, for example, in step number 1, you said you established a company. So I said it's a JV. I go to the step number 2, I look at the contractual arrangement and I identified that the parties are getting share in assets, liability, income and expense. I'll say that they've override the concept of separate legal entity by entering into a contractual arrangement. It's a JO. The step number 2 will prevail over the decision in step number 1. The step number 2 will prevail over the decision in terms of step number 1. So then why are you looking at step number 1? If the decision in step 2 is going to override the inputs in step 1, then what is the good need of looking at the step 1? Sometimes there may be no contractual agreement. If there is no contractual agreement, then what is decided by step 1, that's going to prevail. Step 1 is more like a litmus test, where you're looking at a parent level that what is the separate vehicle, how is it structured? But then you need to look at the substance of the legal form. And when you look at the terms of the contractual arrangement and you start digging the agreement, you come to know that they're getting a share in the asset liability, it's a JO. And when you see that they're getting a share in the net assets, net profit, it is a JV. So what you decide in step number 1 is not the final answer. When you look at the contractual agreement and you say that it's a JOJV, step 2 overrides the decision in terms of step number 1. I hope, friends, I stand clear on the agenda. So in this particular case, your step number 2 decisions is going to be in this case. Now, I'm getting a question, if it is a proprietorship firm, how can it be a proprietorship firm? Because the arrangement is between minimum of 2 parties. So when you go to enter into an arrangement, you need to create a vehicle which is either of the three, not a sole proprietorship. Correct? Okay, so this is one input. Now let's take the journey forward. Now, in this particular case, if there is a legal form, you go to the contractual terms. But if the contractual terms are silent, don't worry, I'll document the chart as well. So you look at the legal form, then you go to the step number 2, and if the contractual arrangement gives you contradictory answers, you get the result. There is no need to go to step 3. If your inputs in step 2 is available, there is no need to go to the step number 3. It is only when the contractual term is silent, you need to see other facts and circumstances. In this case, you need to see any other relevant facts and circumstances which might be indicating a contrary decision to step number 1. So you need to see the other facts and circumstances which might contradict your answer to the step number 1. So let's get the chain very clear now. I will look at the legal form, and if the legal form tells me it's a company LLP, it's JV. If it is a normal partnership firm, JO, I'll still go to step 2. Now, data in step 2 is not there. There is no contractual arrangement. You go to step 3. And the data in terms of step 2 is available. Don't go to step 3. In terms of step 2, now I will say that what have they contractually agreed? Are they going to get net assets and net profits? JV. Are they going to get share in asset, liability, income and expense? JO. But if the step number 2 data is not available, then you need to dig the further facts and circumstances which may indicate the essence that it may be a JV or it may be a JO. Then whatever answer comes in step 3 will override step 1. Now you will say, so then what is the need of step number 1? Maybe there are no other facts and circumstances. Maybe the contractual arrangement is silent. So step 1 is going to play a role if there is no contractual agreement and there is no other facts which are contradicting the decision, then the decision as per step 1 is valid. Otherwise, if there is a contradiction in 1 and 2, if there is a contradiction in 1 and 3, the step 2 prevails over 1, the step 3 prevails over step 1. That is the inputs. Now the question rises, what are those other facts and circumstances that we'll see in an illustration? But let me first document the 3-step model in detail. So we're looking in terms of deciding the type of the arrangement. So let me put the 3-step model. The first question we've already seen. So I'm not putting that again. We've already put that. If a separate vehicle is not there, it's a JO. If it is there, then it is a 3-step model. So we're looking at the 3-step model. Step number 1. In step number 1, we will put across a question. What is the structure? What is the structure of the separate vehicle? So what is the structure of the separate vehicle? So we will put across a question that what is the structure of the separate vehicle? So we can say the structure of the separate vehicle could be either of the 3. So it could be a company that you've organized things in a company form of organization, or it's an LLP, or it is supposed to be a firm. Now, this insights which I've given you is based on the insights which is given in one of the Ind AS bulletins. And this clarification was given in one of the Ind AS bulletins by the Accounting Standard Board that, this is how you decide that whether a separate legal entity is getting established. So when you look at the structure, the idea is to evaluate whether separate legal entity is getting established or not. Whether separate legal entity is getting established or not. So the idea of evaluation of this parameter is to say that whether a separate legal entity is getting established or not. So if it is a company, the answer is yes, it is getting established. LLP, yes, it is getting established. Firm, no, it is not getting established. If it is getting established, it becomes JV. In this case, JV, and in this case, it is joint operations. But we will still go to the step number 2. We will still go to step number 2. So irrespective, whatever you decide, we need to still go to the step number 2 again. So now let's have a look in terms of the step number 2. Now, in terms of the step number 2, we will say...
So just one question.
Yes.
So in terms of step number 2, we will be going only for those company and LLP. There cannot be a contraindication that subsequently, in case of a partnership, the terms may establish that it is a separate legal entity. Can it be?
We will. On the very apparent look, it's a firm, and we say separate legal entity is not established. But when I look at the agreement, they say that we're going to share net assets and net profit.
Correct.
It becomes a JV.
Correct.
So irrespective, whatever status might be decided in step 1, step 2, you have to go. You have to go to the step 2. Because the basic essence is looking at substance over the legal form. So we're trying to dig, that in substance, what is the face? The step number 1 is more like a litmus test, on the face of it, what does it look? But then when you start digging the arrangement, the terms, you find something, a different story altogether. Right.
Thank you, sir.
You're welcome. Okay, now I think let's go to the step number 2. So in terms of the step number 2, we'll see the contractual arrangement between the parties. We'll look at the contractual arrangement between the parties. So I would say that there are 2 permutations, combinations in this case. When you look at the contractual arrangement, either we can say there is no contractual agreement. Yes, it is there, or we can say no, it is not there. If it is not there, then you go to step number 3. And if it is there, then we will not go to step number 3. So we will not go to step number 3, but we will evaluate in this case. We'll dig the agreement and see. So we'll dig the agreement and see that parties are getting what? So we will see that the parties are getting. We will evaluate that the parties are getting, you can say, share in net assets or net profit, or they're getting a share in the assets, liability, income, and expense. So we'll have to see how they're organizing the arrangement. Now, in this particular case, when you say they're getting a share in the net assets and net profit, it is supposed to be a JV, and here it is going to be a JO. And let me make a mention. Step 2 overrides step 1. So whatever you have decided in terms of the step number 1, that will be overridden by step number 2. So whatever answer comes in step 2, that is going to be the final decision in this case. Now let's say the step number 3. So let's go to the step number 3. And now in terms of the step number 3, we're going to evaluate other relevant facts and circumstances. Now, what are these other relevant facts and circumstances that we'll see in the case study? So we will evaluate the other relevant facts and circumstances. And I think it's worth making a mention that when you look at the other facts and circumstances, we can say the decision in step 3 overrides step 1. The decision in step 3 overrides the step number 1. So if the facts and circumstances indicate something else, I think just to be on a very safe side, let me give you some permutations, combinations to see how you've understood the application of the chart. Let's give you some permutation combinations to think on. So let's say you're taking these 3 steps and I want to take a call and decide. I'm just giving you some, some basic permutations, combinations to decide. So let's say this is step 1, let's say this is step 2, and let's say this is step 3, and let's see what is the decision. Let's give you some permutations combination. We created a company. Can you tell me JO or JV?
JV.
Wonderful indeed. So I go to the step number 2 and I see that they are getting a share in the net assets and net profits. So what is it, JO or JV?
JV.
That's right. Are we going to apply step 3?
No.
No. So the answer is it becomes a joint venture. Now let's take the same combination. So this is the same. Now let's say they're getting a share in the assets, liability, and the income and expense. Now tell me, what is it?
JO.
JO. Are you going to apply step 3?
No.
No. So it becomes a joint operation in this case. Now, let's take another combination. Let's say we created a company. So it's a joint venture. This is silent. This is silent. So can I say, are you going to go to step 3?
Yes, sir.
And let's say even if this is silent, then can I call it as a JV?
Yes.
Okay, now let's take another case. This is same. And this is again same. It is silent. But this now indicates a contrary. This indicates a contrary data. Now, what do I say? Joint operation? Correct. So this is not an exhaustive list of things, but just to give you a thought process that substance over legal form is taking a precedence. You're looking at the terms of the arrangement, you're looking at the facts and circumstances, and if they indicate something contrary to the face value, to the structure created, it's going to change the decision. Right, so far so good. I guess we stand very clear on this input. Now let's go to the case study. We need to still understand what is the relevant facts and circumstances that we'll understand in a question. So let me, I guess, first take you right. I'm going to take one interesting input. This is the illustration number 19, which is a comprehensive one, which is going to give you the structure. So illustration number 19. So let's have a look at details on illustration number 19. So we're going to apply the entire thought process, what we have learned in this particular illustration. This is also given in the standard as well. So it's given in the standard and it's in the study material as well. Let's read the inputs. It says the parties structure a joint arrangement in an incorporated entity, that is A. My question number 1, did you create a separate vehicle? Yes. So what do I do? Apply a 3-step model. Now it says in which each party has got a 50% ownership interest. The purpose of the arrangement is to manufacture materials required by the parties for their own individual manufacturing processes. The arrangement ensures that the parties operate the facility that produces the material to the quantity and quality specifications of the party. The legal form of A, an incorporated entity through which activities are conducted initially, indicates that assets and liabilities in A are the assets and liabilities of A. So is the separate legal entity established in step number 1? Can I call it as a JV?
Yeah.
Yes, sir.
Yes. So we can say if I look at my step number 1 and I apply the concept of looking at the legal form of the entity, we can say we can reach a conclusion it's a JV. But we'll still go to the step number 2. The contractual arrangement between the party does not specify that parties have rights to assets or obligations for liability. So is the step number 2 silent?
Yes, sir.
Yes, if you look at the step number 2, there is a complete silence, lack of data. So we need to go to the step number 3 and look at other facts and circumstances. Then he says there are following other relevant facts and circumstances applicable in this particular case. Now, let's look at the facts and circumstances clearly. The parties agree to purchase all the output produced by A in the ratio of 50-50. So these parties have organized a separate entity and the 100% of the output is being taken over by these parties 50-50. Entity A cannot sell any of the output to third parties unless it is approved by the two parties to the arrangement. Now, let me say something at this end. When we're looking at the concept that it might be a JO, we say that they get a share in the assets, liability, income, and expense. Now, let me ask you something very logically. Please evaluate this facts very clear. The parties have created a separate vehicle and the entire output of that vehicle is going to the parties A and B. I would say the entire output of that vehicle represents the economic benefits of that vehicle. And when I say the economic benefits of the vehicle goes to the parties, economic benefits is nothing but represents the assets. So when you say that the output represents the entire economic benefits coming from the entity and the entire economic benefits are shared in the ratio 50-50, which means that when they share the economic benefits, which is indirectly the assets in the ratio 50-50, are they getting a share in the net assets or are they getting a share in the assets?
Assets.
That's right. So in this particular case, since there is no third party sale, which means that more or less when I'm going to look at the other relevant facts, my focus will be to see that is there any third party sale happening or not. If there is no third party sale happening, that would indicate that the parties have got a share in the assets of the entity. Because the purpose of the arrangement is to provide the parties with the output they require. Such sales to third parties are uncommon and not material in nature. So this indicates that they are getting a share in the assets of the entity. Then I'm given another input as well. It says the price of the output sold to the parties is set by both the parties at a level that is designated to cover the cost of production and administration expense. He says the price at which the output is sold by the structured vehicle is to meet cost to cost. Now that's another interesting point. The money which is provided by the parties is able to only sustain that separate vehicle. So its all liabilities are indirectly paid by the parties themselves. Because it's a hand-to-mouth situation, which means all the liabilities and all the expenses of this particular entity is indirectly paid by the parties itself, because there's no third-party sale. And the price fixation is resulting in a break-even point. On the basis of this, the management intends to do a break-even. That means with this break-even, you can say they are getting a share in all the liabilities and expense. So I think there are two factors which comes out of this illustration. That if you look at the facts and circumstances indicating that it could be a JO, you need to put two questions. Number one, is there any third-party sale? If there is no third-party sale, that would mean that you're getting a share in the assets. The second is, what is the price at which the output is sold? If the price at which the output is sold is to ensure a break-even to the separate vehicle, that means they're bearing the liabilities. The facts and circumstances are indicating that it is supposed to be a JO. Based on the above pattern, whether the arrangement is a JO or a JV, now it says the legal form and the terms of the contractual indicate it's a joint venture. However, when you look at the other facts, it says the obligations of the party to purchase all the output reflects an exclusive dependence of A for the generation of cash flows, and thus the parties have an obligation to fund the settlement of liabilities. The fact that they've got rights to all the outputs produced means They're consuming, and therefore they have right to the economic benefits, the assets. So I would say the factor is you get the entire output, so you get a share in the assets. You pay a price equal to a break even, so you bear the obligations. The facts and circumstances indicate it's a joint operation. Now, there is some more clarification which is given in the last para. I'd also like to read that input as well. It says, if the parties change the terms of the arrangement so that the arrangement is able to sell output to third parties, this would result in a assuming demand, inventory, and a credit risk. In that scenario, the change in facts and circumstances would require a reassessment of the arrangement, and this would indicate it is supposed to be a joint venture. So I think it's made very clear. The sale to third party is important. The price at which the sale is made to the parties of the arrangement is important. So let's go back and document this input as well. So let me just, I think, come back to this input which I gave you. So I'm just going to add the inputs in terms of relevant facts and circumstances. So I would say in terms of the relevant facts and circumstances, there are two things to be seen. The number one, the first input you got to see in this case is that no third party sale. The input to be seen is that there is no third party sale. So we are saying 100% output. 100% output is taken away. 100% output is taken away by parties to the arrangement. By parties to the arrangement. So they take over the entire output in this case. No third party sale. That's one factor. The second factor which we need to consider is the price at which output is sold. The price at which the output is sold. And we can say this will be to ensure break even. This is to ensure, you can say, a break even. So can I say if these two factors are met, if both the factors are met, so what do you say, JV or a JO in this case?
JO.
That's right. No third party sale and the price is to ensure a break even, that would indicate a JO. So indirectly you can say if any of these parameters is going to fail, then of course the decisions is going to be different. So that gives us the block number 2, which is in terms of deciding, that, whether it's a JV or a JO. And as I said earlier, if it is a JV, you're out to Ind AS 28. And if it is supposed to be a JO, then you are within Ind AS 111. Okay, now it's time to go to the block number 3 to give you some inputs and give you some permutations, combinations of what kind of accounting would apply. We'll do practical illustrations also. Maybe the time may not permit me to do illustrations today. No worry, we're going to do that in the next session with some comprehensive questions on consolidation. But let's first go to the block number 3. Now, I'm interested in making a super duper chart in terms of block number 3, giving you the insights in terms of all the permutations and combinations. Let's go to the block number 3. And that is in terms of accounting. So I think this will give you the essence of all the permutations, combinations. If this is clear, then I think indirectly we are talking in terms of 27 as well. So I'm going to create some interesting permutations, combinations. Let's put it like this. We'll first of all broadly divide this in terms of 2 parts. I want to look at the separate financial statements and consolidate financial statements. Then I'll divide this further in terms of 2 blocks. And in terms of the 2 blocks, I'm going to further divide this in terms of another 2 blocks. So I'm looking at the concept that if it is supposed to be a joint venture and if it is supposed to be a joint operation. Now let me tell you, in terms of JV and in terms of JO, why I've created two columns. Remember the case of that ABC? A got a 50, B got a 30, and C got a 20. So I said AB is having a joint control, C is not having a joint control. So we're looking at parties with joint control. We're looking at parties with joint control, and we're looking at parties with no joint control. Parties with no joint control. So to illustrate this input, so we're looking at ABC, the same example. He's got 50, he's got 30, he's got 20, and we need a majority of 75%. So we can say A and B have a joint control and C is not having a joint control. So I'm looking at parties with a joint control, A and B. I'm looking at parties with no joint control, that is C. So here we're looking at A and B, and here we're looking at C. I hope the chain is clear. The combination chain is clear in the mind. What are we looking at? This is again parties with joint control. That is A and B. And we're looking at the parties with no joint control. Parties with no joint control, and that is we're looking at C. This is a comprehensive chart indicating the permutations, combinations in terms of which standards would trigger. Because if you read the standard, they've also made a very clear-cut distinction between the accounting in the books of those parties who are a party to the joint arrangement and having a joint control, or parties to the arrangement who have got no joint control. Let's begin. So I'm first going to look at the parties with a joint control A and B. So would you like to tell me which standard will apply in separate financial statements?
27.
Very good. I gave that earlier also, that this is going to be as per Ind AS 27. And consolidate financial statements, can I say depends? No, sorry, this is joint venture already, sorry. So can I say in this case, which standard would apply for consolidation? It's a JV.
111.
Ind AS 28, joint venture. So you're going to apply the equity method as per Ind AS 28, right? I hope I'm clear.
Yes.
So Ind AS 27 tells you it can be taken at cost or it can be taken at fair value. You get a choice in this particular case. So they will reflect the investments at a cost or at a fair value. That is a choice of the company. In consolidation, they will apply Ind AS 28. Okay, let's go to the parties with no joint control. Can I see if they've got no joint control, you'll have to see, do they have significant influence? And I have to put a question and ask myself that do they get a significant influence? So either the answer is a yes or a no. So if the answer is a yes, would you like to tell me which standard would trigger in this case?
27.
That's right. And if the answer is a no, they do not get a significant influence.
109.
Very good. Because that's what we did in 103, control sequence, joint control sequence, significant influence sequence, otherwise passive investment. So in this case, it'll be Ind AS 27. And if there is no significant influence, then it is Ind AS 109. And the same position continues for consolidation as well. So can I say 28 here? For consolidation point of view, yes.
Yes.
So this will be Ind AS 28. And what about if the answer is no significant influence? Can I say no consolidation?
Oh.
So there will be no consolidate financial statements in this case. Right. So I think this is as far as a joint venture is concerned, that if there is a JV, you need to see that your focus is on which kind of party. The parties have got a joint control, 27, 28 for separate and consolidation. If they don't get a joint control, significant influence, the status is same. It's no significant influence, then it is passive investment. Okay. Now let's come to the concept of a joint operation. And the interesting part is, does Ind AS 27 apply in terms of separate financial statements for a JO? I gave that answer also earlier. So would 27 apply? Would Ind AS 27 apply? No, no, no. So in this case, let me tell you, in all these cases, there is going to be a common accounting. In all these cases, there is going to be a common accounting. So whether it is a separate financial statements or it is a consolidated financial statements, we will apply Ind AS 111. Separate financials also, consolidated financials also, Ind AS 111 would apply. Now, what is that Ind AS 111? Ind AS 111 in this particular case says that when you take the assets, you will take your own assets and add the share in the assets. When you take your liabilities, you're going to consider your own liabilities plus the share. Same goes for the income and same goes for the expense. You're going to consider your own incomes and you'll add the share in the joint operation. You'll take your own expense and you will add the share in the joint operation. So whether it is a separate or a consolidated financial statements, the investor, the party to the arrangement, and it doesn't make a difference to these combinations as well, you will take your assets and the share, your liabilities and the share, your incomes and the share, your expense and the share. And let me tell you, this can be indirectly, though it is not technically called so, it is indirectly called proportionate consolidation technique. Though this terminology is not used in the standard, but we use it for the understanding point of view. Because when you say that I will take share in the assets, share in the liability, income and expense, you're basically doing what is called a proportionate consolidation. So, depending upon the type of relationship, the consolidation technique also applies. When you look at the case of a control, it's full consolidation because you get a control. When you get a significant influence, it is supposed to be a case of one-line consolidation because it is less, 20% or more, but less than 50, up to 50. And when it is a joint control, you're getting a proportionate consolidation. But trust me, whether you do a consolidation which is full, or you do a consolidation proportionate, or you do a consolidation one-line equity, the essence of all the consolidation is same. It's just a way of presenting the consolidation. In a full consolidation, you aggregate all the assets and liability, show the NCI. So what do? You aggregate the share. In a proportionate consolidation, you're as it is aggregating the share. In terms of one-line consolidation, you say, let me calculate the share in the net assets directly. So the essence of consolidations in all these three cases, 100% the same. Right, friends, I hope I stand very clear on my thoughts on the block number 3, the accounting chart as well. Clear with the funda? Wonderful indeed.
Yeah.
Now, the only thing is that when you look at the concept of a joint venture, I would say this accounting is practically covered because we've covered 109, we've covered Ind AS 28 as well. Now, the only thing to be seen is this accounting. So that means we need to see that how the accounting for a joint operation is done. We'll see that in the next session. I don't want to rush that through. So we are now left with, you can say, a practical illustration with reference to Ind AS 111. How does the accounting for a joint operation take place? And as I said, I'm planning to consider doing a question on a balance sheet and on a P&L, which is going to combine the subsidiaries and the associates all put together. That kind of questions cannot come in the exams, but that kind of question is only to give you a flavor and get a hold in terms of different kinds of adjustments which are there. Do you want me to do that kind of illustration in the next class with you?
Yes, sir.
That's wonderful indeed. So you want me to do that on the board in the next class, or you want me to do it on the Excel sheet? Your choice.
Board, sir.
Okay, board. So because accordingly, I will create the arrangement, because if it is Excel, then I'll have to use my laptop. If it is going to be the other way around, then I'll use the board. So done. We're going to use the board because in any case, in the exams, you also have to do the writing. So I
Different
think
colors.
that makes sense. Yeah. Somebody's saying Excel. So I think in the exam, since you don't use the Excel, I think we'll go with the board. So I think we'll do that comprehensive question. So I think that's all. I think we're not taking that last 5 minutes indeed to do anything new. So next class will be our last class on the consolidation. We'll wind up with the entire consolidation process in the next class. Right, friends, over to you for any questions. Otherwise, I think that's all for the day.
No, sir. Thank you.
Okay, thank you very much then. So see you in the next class. Be well prepared for the question which I'm going to do this. So we're going to do a comprehensive question. So please revise 28 as well as 110 so that we are able to do this question well. Thank you very much. Bye-bye and take care.
Thank you, sir.
Thank you.